So have you ever wondered how it's possible that some of the wealthiest people on the planet can legally pay little or even zero in income tax? Meanwhile, you've got high-earning professionals getting hit with these absolutely massive tax bills. Well, that is the exact question we're going to answer right now. And listen, this isn't about cheating the system, it's about understanding the rules of the game.
Just look at this. On one side, you've got a surgeon, makes $500,000 a year, which is incredible, right? But they're handing over 150 grand of that straight to the IRS. Now, on the other side, you've got an investor with a $20 million property portfolio. Their tax bill? A big, fat zero. How on earth is that possible? It really makes you wonder, who is really working for whom here? And I'll tell you, this is not a mistake. It is a very deliberate strategy, and we are going to break down exactly how this strategy works. Welcome to The Explainer. If you are ready to finally understand the real rules of money, do me a favor, hit that like button and subscribe, because you are not going to want to miss these deep dives. Okay, let's get into it.
All right, the first thing you have to get your head around is this. You need to completely change how you think about taxes. Most of us see tax as, a penalty for being successful, but the source material puts it perfectly. The tax code is not a punishment, it's a roadmap. Think of it like a 6,000-page book of incentives that the government wrote to tell you exactly what they want you to do with your money.
So to follow that roadmap, you've got to know the lay of the land. And the most important thing to know is that the IRS does not treat all money the same, not even close. There are three basic types of income, and knowing the difference between them is really the first secret to building tax-free wealth.
Okay, let's break this down. First up, you have earned income. That's your salary, your wages. It's what almost all of us are taught to go out and work for. And guess what? It's the highest taxed income there is, period. Then you've got portfolio income, from stocks and bonds, which also gets taxed pretty hellily. But then there's the third one, passive income. This often comes from real estate, and it gets the absolute best tax treatment. And you have to ask, why? Well, it's because the government wants to incentivize people like you to provide housing. It's that simple. When you do something the government wants, they reward you for it. Now, this is where it gets really, really cool. How exactly does the government reward you for providing that housing? Well, the answer lies in this incredibly powerful accounting tool, a concept the source calls phantom expenses. This is the core trick, the main mechanism that lets real estate investors legally wipe their taxable income right off the map.
And that phantom expense has a name: depreciation. You see, the IRS lets you write off a piece of your property's value every single year. They're basically saying it's wearing out, even if in the real world, its value is going through the roof. That's why it's a phantom expense. No money actually leaves your bank account. It is a loss that only exists on paper, specifically for tax purposes. Okay, let's make this super simple. Imagine your rental properties made you $50,000 in real cash profit this year. That is cold, hard cash in your pocket. You can spend it, you can save it, whatever. It's real.
But then, your accountant works their magic. They apply depreciation, and on paper, they claim a $50,000 loss because the building is wearing out. So what's your taxable income? Well, your $50,000 cash gain minus your $50,000 paper loss equals zero. Boom! You keep all the cash and you pay zero tax. This, my friends, is the holy grail.
And believe it or not, this strategy is even more powerful right now. The source points to a new piece of tax law which restores something called 100% bonus depreciation. What that means in plain English is that investors can take a huge chunk of those paper losses in the very first year they own a property. We're talking about a massive, immediate tax deduction. It's incredible.
Okay, so you've used these phantom expenses to get your income tax down to zero. Great, but how do you actually get to the millions of dollars of wealth that are locked up in your properties without, selling them and triggering a huge capital gains tax? Well, that brings us to the next piece of the puzzle, a strategy famously known as buy, borrow, die.
The strategy is a really simple but powerful three-step cycle. First, you buy an asset that's going to go up in value, like an apartment building. Second, as that building's value grows, you borrow against that new equity. And this is the key. That loan you take out is tax-free. Third, you can literally live on that borrowed money, or even better, use it to buy more assets, which then appreciate in value. And the whole cycle starts over again.
And this right here, this is the secret sauce. This is the single most important rule that makes this entire thing work. The IRS does not consider debt to be income. When you go to the bank and they give you a $2 million loan against your property, that is not a $2 million taxable event. It's just debt. And this is how the wealthy fund their entire lifestyles without ever getting a tax bill. So we figured out how to zero out our real estate income, and we know how to access our wealth tax-free. But what about that surgeon from the beginning? The one with that huge salary and that massive tax bill? Well, this is the master key. There's a way to connect those real estate paper losses directly to your high-tax salary and completely wipe it out too.
You do it by qualifying for something called real estate professional status, or REPS for short. Now, the rules are very specific. Either you or your spouse has to spend more than half of your professional time and at least 750 hours a year on real estate stuff. If you can meet that test, then suddenly those paper losses from your real estate aren't stuck in their own little box anymore. You can use them to cancel out your active earned income. That is how a doctor can use the depreciation from their rental properties to erase the tax on their surgery income.
So when you put all these pieces together, understanding the 3 types of income, using phantom expenses like depreciation, accessing wealth through debt, you start to see the big picture. The tax system isn't really about taxes. It's a game of incentives.
And that really brings us to the ultimate takeaway here. The tax code isn't designed to be fair, not in the way we normally think about fairness. It's designed to get you to do certain things. The government wants people to provide housing. They want people to create jobs. And if you do those things, the rules are literally written to give you a massive reward. If you just work for a salary, well, the rules are written for you to pay the most.
Which all leads to one final, really important question, and this one's for you. Now that you've seen the roadmap, now that you understand the rules of the game, what are you going to do? Are you going to keep playing the game they taught us all in school, working for money and paying the highest taxes? Or are you going to start playing by the rules the wealthy use and finally make your money start working for you? The choice and the opportunity is all yours.